Have you ever wanted to invest in gold safely without giving up those market gains? That is really a classic investor dilemma that we see. On one hand, gold is a very powerful hedge when it comes against inflation, recession, and the market chaos. On the other side, equities have always historically been one of the best growth engines we've seen within the market and long-term growth. Usually you have to pick one or the other, or splitting money and holding both of those investments. But what if you didn't have to choose at all? And what if you could only have one fund? In today's video, we're going to be looking at the GDE, which is a mouthful when it comes to the WisdomTree efficient gold plus equity strategy fund, or this ETF tries to give you the upside of equities and also gold protection in the portfolio, which is interesting, all in one single straightforward ETF. So today we're going to be breaking down the GDE, looking at exactly how it works, historical performance of this ETF, what risks you need to understand, and does it belong and have a spot in your portfolio? So stick around to the end, guys, because I'm going to share with you exactly how professionals are thinking a fund like this is going to work, and also mistakes that you definitely want to avoid. Now, what exactly, in talking about the GDE, what is this ETF? So it's simple. Gold and equities traditionally do not move in the same way, just like we see with stocks and bonds. When stocks drive, when the economy is growing, gold shines when inflation spikes and real interest rates fall. There's a market panic. That is when gold really does shine. If you're all in one equity, you might be overexposed to inflation or a crisis period, but have moved too much into gold, you could be giving up some of that long-term compounding interest that we see. This is why many investors are split between both of these, maybe 80% stocks, 20% gold, but that means sacrificing one side or the other side to get the growth or the protection in there. Now, the GDE aims to fix that with a trade-off. It is designed to give you exposure simultaneously using a technique called a futures overlay in here. And this is where it gets interesting. So what exactly does it do and how does it work? So here is the very basic idea behind this. For every $100 you invest in the GDE, 90% of it goes to a portfolio of large cap US equities. When you think of Amazon, when you think of Apple, Nvidia, and other S&P 500 giants, 90% of your money, or $90, are going into those funds. But here is the twist and what makes this ETF unique. There is also a gold futures contract to get you roughly $90 worth of gold exposure. On top of that, it keeps the other $10 as a cash collateral. So in other words, you invest $100, your $100 now controls about $180 worth of exposure, $90 in equity, $90 in gold. That is what WisdomTree is calling the capital efficient design of this ETF. So instead of you're splitting your money 50% stocks, 50% into gold, the GDE uses futures to give you both exposure for that same dollar amount. Very similar how hedge funds or institutional investors operate, but it's packaged in one simple ETF that anyone can buy. The benefit is clear. You don't have to choose between growth or protection. In theory, you're getting both, but there is more exposure, comes with complexity, and complexity does come with more exposure, which means more risk in an ETF. And we'll talk about those in just a moment. So I want to hop in here and show you why it ultimately matters when you look at starting and really the comparison of these two. Now, here we are on ETF.com. So we know one of the tried and true videos, the SPMO, the Momentum Fund. Everybody loves this. It does incredibly well. Then we're looking at the GDE, which of course is the gold efficiency that we see in there, versus the VOO. Now, the Vanguard S&P 500 has kind of been the staple of the stock market itself. And a lot of people do see that as the market itself within the VOO. So again, I want to break this down a little bit and show you kind of what we're looking at based on the performance. So looking as we're sitting right now, the SPMO is at a 31%. The GDE is almost at a 40%, 39.58, while we have the VOO at 16.25. And even thinking of this within the last 12 months, the VOO at 16.25% is really your foundational ETF, but it is still doing incredibly well when you look at an average return around 10%. Within that VOO, seeing it at 16 so far this year, especially because we've seen the dip in April, as you can see through all of them, it's very interesting. So then we back it out and really scale it out a little bit. So looking in the SPMO, we're at 2.5%. The GDE is at a whopping 10% in the last month. That is a huge increase. Then you look at the VOO 2.29. So again, underperforming. Then we get into the last 3 months, guys. The GDE is at a 21%, SPMO at 8%. We have 8% in the VOO. So again, you're kind of seeing where the GDE is just absolutely crushing it. Year to date, 27%, which again is kind of crazy to think in comparison with the VOO of 14. The GDE is at 50%, guys, 50% year to date. So in the last 9 going on 10 months, we have seen a 50% increase in this ETF, which is kind of crazy. But it gets even higher than that, because when we start looking at the 1 year, it's at 53%. Even looking 3 years, we are at a 47%, even eclipsing the SPMO at that 34% and the VOO at 23%. So again, very interesting to see long-term what this is going to do. And this was actually recommended from one of my viewers to go ahead and look at, wanted to do the research, wanted to break this down, because it's also interesting. Expense ratio on this one, still super cheap. When you look at a 0.20, really anything under about a 0.5 is incredibly cost efficient when it comes to ETFs. And this one is no different. Now the holdings, this is where it gets very interesting, because you can see the difference between these. And really it is this mutual fund other, which from my understanding, this is what holds roughly 10%, like we were talking about. And this was holding it into gold futures from my understanding. And again, kind of looking at it, but then you get below that, NVIDIA, Microsoft, Apple, Alphabet, Amazon. You have, like we said, if you invest $100, $90 of it is going into this. $10 is going to be held in cash, which is that mutual fund other, which is holding it. And then you are going to have the gold futures in here, which is generating a crazy amount of return based on the gold in there. So again, you have exposure in 90% of this ETF is these companies. And when we start breaking it down, you can see all of the growth, everything that they're in, from electronic technology, even finance, resale, trade, most of them are around the exact same places. Even percentage-wise, you can see they are very similar in the structure when we start breaking these down and how they have the exposure to really a lot more of the tech companies that we do see within here. So again, it's interesting to see the build of this and seeing how it is generating such incredible returns over that amount of time. But let's hop over, guys, and keep kind of going through here, because I want to make sure that we do cover it all. So since the launch, you can see it's done incredibly well. It is roughly 55%. When you look at the GDE, really 90%, about 55% in gold. That is because the stock market has been in fire on the exact same time. But what kind of risks come with it? Now, this is the one you never want to skip. You cannot ignore the risk on things like this. Risk number one, it is leverage. Because the GDE uses futures, you're getting a lot more than that $100 exposure that you're investing in there, which can magnify the gains. It works on the flip side, guys. It can also magnify the losses that we see in this ETF. If both stocks and gold drop at the same time, the GDE will likely fall hard, much harder than a simple equity ETF. You're going to see a much greater pullback because of the leverage. Now, also risk number two, the future costs. Future contracts have been rolled out on a regular. We are seeing it in a crazy amount of ETFs. If gold future market becomes kind of oversaturated, the future price could really go higher than the spot price, eating in those returns, or really you're going to eat into those returns over time, even though I know it's kind of short in the run that it's been in the last 3 years. When you start looking 5, 10, 15, 20 years out, what exactly does it look like? Now, risk number three, just the basic risk. The performance of gold futures is not always identical to spot gold. That is the difference, known as the basis risk within the ETF, can sometimes cause the GDE to underperform where you would expect it to be. And then, of course, the complexity. If you're looking for a simplified portfolio, this might be not one that you just want to go ahead and skip. It is not for the plain vanilla, the QQQ, the VOO, the SCHD. It uses derivatives, it uses collateral, it uses leverage. If you don't understand those mechanics, I always recommend, and I always really do talk about, making sure when in volatile markets, or if you don't understand it, do your research and know exactly what you're going and what you're investing in. It is a very sophisticated ETF that we see in the marketplace. So how exactly could this fit into your portfolio? If you are risk minded, like I am, thinking about 20, 30, possibly even 40 years to retirement, most professionals would not make it a core holding by any means. It is more of a satellite position of roughly 3 to 5%. Maybe if you're risk averse, you could even take it to 10%. Has diversification in hedges, really the micro risk. It wants to be really a complement to a portfolio, not to replace existing holdings in their entirety. They kind of treat it as an insurance policy without sacrificing the growth engine that we see from like a QQQM, and also rebalance regularly. This is going to be huge, where if the GDE rallies, it will become a much larger portion of your portfolio at a much faster pace. Rebalancing can actually trim your position, making sure that we know the macro trends that are going on in the system. And if inflation falls or gold enters into a bear market, it may weaken when it comes to this ETF. So what else is out there, guys? There are a couple other funds that kind of do similar things with the exposure to the gold. A couple alternatives, the GDMN, which combines gold miners with gold futures. Again, a little bit easier. If you look at the GLD, if you just want the simplicity of holding gold itself, that's all you need. You gives you a lot more control, but you don't have quite the exposure to the futures. Or you could just buy equities that are, again, pure gold versus what the GDE does offer. So is it worth considering? Honestly, if you're a long-term investor that wants to hedge inflation, macro risk without sacrificing your equity growth, it is a very cleverly built and designed ETF. It's capital efficient, historically strong, and really resolves and really solves the portfolio problem of holding gold and holding equities. But it's not for everyone. Again, with the leverage, you got to be careful with the risk in there. Brand new to the ETFs, this might not be the starting point that you want to look at. But if you're a seasoned investor, again, if you put 3-5% in there as a satellite outside of that main portfolio, might even be worth it. So what do you think? What is your thoughts on the fund? Drop a comment. I'd love to hear your take on the GDE. If you found the breakdown helpful, definitely hit that like button, subscribe to the channel. And of course, we're going to do deep dives in a lot more of these ETFs for the better understanding that I gain and also that you gain. So thank you guys for watching. Remember, smart investing isn't about chasing those mega returns. It's about building those portfolios that are very resistant. They can weather the market even in a down market. And of course, this could be one built in there that could be very resistant. And I'll catch you in the next video.